Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Hey, welcome to this episode of the Australian Finance Podcast. It's my pleasure to have you with me.
It is good to be back, Owen.
Today we're talking economics. We're talking all things economy. This is a topic that we've broached once before, and we should have done it sooner again because there is so much interest in things like interest rates, inflation. Like even during COVID, we heard this scary term called a recession, and a lot of people were pretty scared about that. So, Kate, maybe I'll let you introduce our guest, given that you spoke to him previously, and then we can just jump into some questions from there. We've got some listener questions to fire away as well.
Yeah, so listeners might remember about 6 months ago, we had Dr. Sam Wiley from Melbourne Business School on the podcast, and we talked a bit of a basic crash course on economics, interest rates, all of that stuff. And I remember we were talking about fixed mortgage rates and all that sort of stuff back then. And there's been definitely a lot of developments in the last 6 months, and we had some great audience feedback from having Sam on the show. So Sam, welcome back onto the podcast today.
Thanks, Kate. Thanks for inviting me. Hi, Owen.
Fantastic to have you with us, Sam. The topic at the tip of everyone's tongue right now is inflation. What does that mean? And then the idea that interest rates have to go up to protect us against that. And I know we've talked about this previously, but I guess maybe we can start off with a very kind of simple question, Sam, that is kind of narrow. Are you surprised that we are talking about inflation in 2022 as much as we are?
It's not surprised. It was inevitable to a certain extent, Owen, that inflation would become the big question after COVID-19, because inflation, as you know, means the prices in the economy going up. Prices of cars, of houses, of restaurant meals, of clothing, of everything, of all the goods and services. You know, goods like, as I said, cars and computers and phones, and services like Uber rides and restaurant meals and holidays and the like, and education and the like. So the price of goods and services going up in general across the economy, that's what inflation means. It's just like blowing up a balloon. There's some pressure that's forcing everything up, everything out. And so that's what inflation means. And there's different types of inflation. And what we're referring to here is consumer price inflation, the cost of living, as they say. And that's the CPI. That's the thing that is put together by the Australian Bureau of Statistics. It's reported every 3 months in Australia, and it's a big deal when it comes out, the cost of living. And it's an index. I know I'm banging on a bit here, but it's an index which means it's helpful to explain what an index is. So if I was to say to you, Owen, you know, what happened to inflation last year, it's unhelpful to come back with computers up 6% and airline travel down 5% and cars up 4% and chewing gum up 3%, etc. You know, it's unhelpful for you to bang on and on about it. It'd be good just to have one number that tells me how much prices and the cost of living went up. And that's what the CPI is. That's what the Consumer Price Index is. It's an average across 125 different things that an ordinary household buys, and it's a weighted average. So things that are really important, like healthcare and transport and housing, the really big ticket parts of what you spend money on, they have a lot of weight in forming it. And things that are smaller, like, you know, sporting equipment and restaurant meals and Uber rides, they're important in their own right, I know, but they're a lot smaller than the other ones that I mentioned. So they enter the index with a smaller weight. And so the Australian Bureau of Statistics collects it all by surveying lots of households. They create that weighted average. They publish it every 3 months. That's the cost of living. And so going back to your question, am I surprised that that's the that's what's on the tip of everyone's tongue and the main concern about the economy. Well, not really, because prices are going up so much because there's been so much stimulus of the economy. I mean, what causes prices to go up a lot here is that demand is growing faster than supply. So if people, if the amount that people want to buy of all of those things is going up faster than companies are supplying it, then there's a lot of competition for those goods and services, and it drives all of those prices up. But there's another thing, and that's how much money there is in the economy. And so you can imagine that the price level depends upon how much money there is in people's bank accounts and in their purses and wallets and the like. I mean, say that the central bank, which we'll talk about later on, the Reserve Bank, say that the Reserve Bank was to increase the amount of money that everyone has by a factor of 10. So we're going to add a 0 to every note that's in your purse or wallet. We're going to add a 0 to your bank account. Then obviously, the amount of money in the economy has gone up by a factor of 10, and the price of everything will go up by a factor of 10. So there's two things that are driving inflation. Is demand growing faster than supply? Is there a lot of money in circulation? And both of those things in COVID-19 went up a lot. There was a lot of stimulus of the economy, and the Reserve Bank, the central bank, pumped a lot of money into the economy. So I know that's a very long-winded answer, and I'm sorry if I've banged on about that for ages, but I think it helps to sort of lay those things out.
Yeah, I think the interesting thing is CPI has been coming up a lot in my circles because it's got to do with HECS and our university student debt. And we're hearing the headlines that it's suddenly going to be indexed by quite a much larger amount than usual this year.
Yeah, that's true. And there's not really anything you can do about that except take the payments that come out automatically from your HECS. So as your income goes up, you pay more and more of your student debt down to a limit of 10%. 10%, once you make, I think it's 130K, then 10% of your salary comes out. Below about 45K, because I don't have any student debt, I don't have the figures. I'm actually, you'll be probably unhappy to know that I'm one of the lucky generation. Like our new Prime Minister, Anthony Albanese, I'm one of the lucky generation who didn't have to pay for their education. So apologies for that. Then I don't have any student debt. My kids have got plenty of student debt. But it's a student debt's like a loan from the federal government. The interest rate on the loan is the inflation rate, essentially, because the amount of debt goes up with inflation, and they take the money out of your wages and salaries, through the tax system. And inflation's 5.1% over the last year. So your student debt will go up by 5.1%. That's correct.
Sam, we talk a lot about on our other show, which is the Australian Investors Podcast, about quantitative easing, which is what people call printing money. Can you explain maybe that process and why for many years that didn't produce the inflation that we're seeing today, but then maybe the stimulus checks are?
Right. So quantitative easing is the creation of new money. And if we just sort of back up a little bit to what normal monetary policy is, then we'll see that quantitative easing is extraordinary monetary policy. It's a very unusual and in many ways very unhealthy thing that had never happened before the global financial crisis in 2008 in the United States and Europe. And had never happened in Australia before COVID-19. So we didn't have any QE, quantitative easing, in Australia before COVID-19. But just backing up to normal monetary policy, it's the Reserve Bank's job to speed up and slow down the economy by raising and lowering interest rates. So, if the economy is running too hot, there's too much demand, and now prices are starting to rise. And so we don't have price stability. We're getting a lot of inflation. Inflation's going up 3, 4, 5%. That's what's happening at the moment, of course. Then the RBA will push the lever up. They'll push the short-term interest rates, the cash rate up, which will have a whole bunch of effects. One thing is that it will cause people to save more and to spend less, because when interest rates go up, then saving is just a more worthwhile thing to do. interest rates are like an exchange rate. They're an exchange rate between the present and the future. If you put some of your money aside, it'll grow at the interest rate into the money in the future. So if you don't spend the money today, if you delay consumption and don't spend the money today and save it instead, then it'll grow at interest rates and investment rates into consumption and spending in the future. And so when you put interest rates up, saving becomes more attractive. And so it restricts demand. It also increases exports and reduces imports because it affects the currency, and it affects the amount that companies invest. So when interest rates go up, the cost of capital is going up. And when the cost of anything goes up, labor or energy or capital, then companies do less investing. So it slows down the economy. The economy is running too hot, then the Reserve Bank will push the lever up of interest rates to slow the economy down to where it's not running too hot and prices aren't rising too much. That's where we are at the moment. Right? Inflation is high, the economy is running too hot. We're pushing up interest rates. But going into COVID-19, we had the opposite situation. So the economy fell off a cliff after all the lockdowns started up. And so the lever was pulled down to speed up the economy. And it was pulled down all the way. And now it's banging on the bottom. So the interest rates were cut to zero, essentially. They're cut to 0.1%, which is so close to zero. Let's just call it zero. And that wasn't enough. So the image you should have in your mind is the governor of the Reserve Bank, Philip Lowe, pulling the lever down, and it's not enough. It's not speeding up the economy. The economy is still falling into the abyss in February and March of 2020. So then he thinks, okay, well, what else can I do? And what he can do is create new money to try and stimulate demand and stimulate inflation, because he's very worried about a deflationary spiral. A spiral downwards where prices start to fall and companies aren't earning enough to pay their workers, and then workers aren't spending, so prices fall even more. He's very worried about a deflationary spiral. He wants inflation. He wants to increase demand. He's pulled the lever down as far as he can. What's he going to do next? Well, he's just going to create money, create new money. And they do that. This is quantitative easing, so not cutting the interest rate, but quantitatively expanding the amount of money. The central bank does that by buying government bonds. It won't help us much to talk through all of the technical details of it, but suffice to say that the RBA writes big checks to buy bonds from Aussie Super, from AMP, from whoever else has got government bonds. And then the bonds go into the Reserve Bank, the central bank, and money comes out into the economy, into circulation, and ends up in bank accounts and ends up in people's purses and wallets. So it was, people say it's the printing of money. It's not literally the printing of folding currency, but it is the creation of money. And it does pump up deposits. And a lot of it was done in Australia in the COVID-19 crisis. A huge amount. Deposits are way up. Deposits are up $600 or $700 billion from what they were before COVID-19 started. So it's that process. It's the emergency thing that a central bank does, and has never happened in Australia before COVID-19. Quantitative easing is the emergency, extraordinary thing that's done when the normal thing of cutting interest rates has hit the bottom, and we can't pull the lever down any further.
Mm. Conscious of hogging all of Sam's time here, Kate, but one thing that kind of leads on from this is we heard in COVID this word, a recession, and people are familiar with it. I think in our minds, we tend to think of the image that comes to people's mind is more depression-like. We think of maybe like the 1920s or something really, catastrophic, I guess, for the economy. Explain what we mean by recession, and I guess whether that's technically defined or whether it's defined in practice, like what it actually means to people, why that's such a big problem.
So let's start with the technical definition, and then we'll unpack it. So you were saying, Owen, that you didn't want to hog all the time. Well, I'm conscious of hogging all the time as well. I'll try not to bang on for too long. But the technical definition is that for 2 quarters, that means 2 lots of 3 months. For 6 months, the economy is shrinking instead of growing. And that's ordinarily that would happen in a normal economy every 5 to 7 years. Australia had this incredible period from 1992 through to the beginning of COVID-19, where we didn't have a single recession at all. We had 30 years from 1992 to 2020, I guess that's 28 years, where we didn't have 2 quarters of negative growth. And mostly that is to do with Australian economy being hitched to the China growth story. China needed the resources that we have, and our economy just grew and grew over a long period of time. So, neither of you might have ever seen a recession. There's certainly lots of young people
very young.
who had not, until it was a surprise, right, when COVID-19 came along. But they are more common than people would ordinarily think. Now, what does it mean to say that the economy is not growing? Well, we usually think about this in output terms. So there's really 3 types of output we should think about. We should think about the production of goods and services that people consume, like Uber rides and computers and holidays and clothing and others. And then there's investment, which is the building of new houses, the building of machinery, buildings, etc. But also non-tangible things like computer software, etc. Not all of investment actually leads to something you can see or touch. If you invest in writing software, for instance, then that's also investment. So consumer products, goods and services, plus investment in new productive capacity, plus exports, or actually net exports minus imports. Those 3 things together make up the output of the economy. And ordinarily, that grows at 2 to 3% per year above inflation. So if inflation's at, say, 2.5%, and we have on top of that real growth, meaning above inflation, of 3%, then the economy is growing at 5.5%. 3% real, and when you add in the effect of inflation, which is just prices going up, it's not anything real, then 5.5% growth. That'd be normal and healthy. And that's great, because it means that our wages are going up faster than inflation. It means that there's plenty of jobs. It means that the high immigration into Australia, there's plenty of jobs for people who are coming along and for the population growth. And it's a very healthy, natural state of affairs. When the economy slows down and goes negative, that's very unhelpful. Unemployment goes way up. The pie that is divided in society between all of us, the output that's divided between all of us, is getting smaller. It's very unhelpful. And that's the circumstances in which the government's going to start to spend more money to stimulate the economy, and the Reserve Bank is going to cut interest rates. And there is a concern that we will be heading into a recession sometime soon.
If we do head into a recession, what does that look like for us as individuals? Because, apart from COVID, we haven't really experienced that before if we're in our 20s.
Yeah, well, the bad thing will be the effect on the labour market, which is very tight at the moment. It's hard to hire people to do anything at the moment. There's so many. So the labour market's very tight at the moment, and wages, unemployment's at a record low of 3.6%. Wages are starting to rise, not as quickly as inflation's gone up. Consumer price inflation's gone up, and this is a legitimate concern and complaint of people that my wage hasn't gone up as much as prices have gone up. So wages have gone up about 3% over the last year. Prices have gone up 5.1%. So you can see that in real terms, workers have gone backwards, and the frustration with that is sort of evident everywhere, including the recent federal election. The reverse of that will happen when a recession comes along. Instead of the labour market being very tight and wages rising and unemployment being low, the opposite will happen. Then it'll be hard to find jobs, and wage growth will go down. So there's that negative impact of a recession. One helpful thing for people will be, if you have a mortgage, then the RBA, to speed up the economy in the way that we've been talking about before, instead of raising interest rates, they'll lower interest rates. And so your mortgage would go down. Your mortgage interest rate would go down if you have a variable rate mortgage. If you had a fixed rate mortgage, then of course it'll be fixed. But that'll be 2 primary effects.
One of those things that you just said there will probably maybe scare or frighten some people, Sam, which is the kind of reversal in the labor market being all of a sudden it's relatively easy to find jobs to maybe it's no longer easy to find jobs. So one of the things that we spoke off air about was trying to kind of relate this to how people can prepare for that if it comes and when it comes or when it comes. How do you think people could, when they're thinking about their employment, when they're thinking about, the real world consequences of this, how could they prepare themselves for this?
Look, it's a very deep question, Owen, and let me say that I think that young people have to take everyone, right? But of course, because your listeners have got more years in the workforce ahead of them than old baby boomers like me. So you need to plan ahead about your long time that you'll be spending in the workforce, and it means that you need to stay current with skills. You need to think that I need to have skills that are in demand in the workforce. And when I was your age, people would do a trade or they'd go to university or something, and then they'd get the skills that they would expect to use through the whole of their career. Well, that's out the window now. So the same thing, do a trade or go to university, get skilled up, but then you have to stay skilled up continually. Work on developing the skills that are needed in the economy. Otherwise, just the pace of technological change means that you'll be sidelined at some stage, and it'll either be hard to find employment or it'll be relatively low income employment. So, what to do to prepare? Well, now I'm talking about, multi-decade thing or long-term strategy as opposed to the circumstances surrounding COVID-19. But I think that's super important. And then a second thing is, as well as upskilling, a second thing is to remain flexible, to be prepared to move jobs or into new areas. And that's a state of mind, being flexible, but also being flexible in terms of being prepared to move from cities, to move from Brisbane to Melbourne, or to move from, Sydney to Perth, to be flexible in your arrangements, to upskill and to be flexible. I think that those are really key things. Part of the reason that inflation is not going into increases in wages. So we haven't seen, like I was saying just a moment ago, that inflation's up 5.1%, consumer price index, but wages are only up 3%. Now, there's more than one reason for that. And the same thing's happening in Europe and in the US, for instance. And a part of that is that people have a long-term concern about their job security. In the back of their mind, there is this fear. Will I be relevant in the workforce? Will there be lots of work for me and the skill set that I have going forward over many years? And part of that fear about whether there'll be plenty of work for them is stopping people from asking for wage increases that they might otherwise ask for. And so we're not seeing we're not seeing a price wage spiral where prices go up, people demand higher wages, which drives up prices, which drives up wages. I mean, that may still be in the future, that may still come, but it's somewhat muted by this fear about people's relevancy in the economy long term. And really, the only way to deal with that relevancy, as I was saying, is keep your skills up, keep a flexible frame of mind.
I think it's interesting because COVID's probably scared a lot of people off from asking for more when it comes to their salary, because so many people did lose their job, and everyone that was employed was very grateful to still have a job throughout 2020 and 2021. And now it's kind of put that fear into us of asking for more. Yeah,
no, I think that's definitely right, and that's a long-term concern for people about whether there is this position for them in the workforce. I mean, COVID. Another sort of layer on this is that COVID has changed people's work arrangements so much. So in renegotiating your arrangements with employers, it's not all about money. So it's about can I work 4 days a week, or can I live in Tamworth and work in Sydney, for instance, or can I live in Townsville and have my job in Melbourne, for instance. So workplace flexibility has become, because it's so much more feasible now to live where you want and to work somewhere else, or to work the hours to spend the hours in the office or in the factory that suit you rather than suit the employer so much. That's a big factor as well, and that's affecting wages as well. It's not all about money.
How about, Sam, the other thing that we tend to do with our capital, if it's not necessarily human capital, it's financial capital, we invest. And that's the thing that we talk about a lot on the show. We've seen for example, more high price, richly valued securities like the technology companies in the world. And if some of our listeners, I'm sure, would have investments in cryptocurrencies and really speculative assets too. There's been a lot of volatility there. And even in standard blue chip names, there is oftentimes some volatility around. And property prices, there's concerns there about, will property prices fall if interest rates go higher, and so on and so forth. What's your perspective on this? Can people feel comfortable investing for the long run now, just like they did a few years ago? Or is there something else that they need to be really mindful of?
Well, look, there's a lot of dimensions to that. So let me try and tick off a few without attempting to. It'll take up the rest of the show for me to try and say. I'll try not to say too much. Let me start off with cryptocurrencies because you mentioned that, Owen. So, we were talking about the supply of money being controlled by the central bank. So in Australia, the central bank is the Reserve Bank, and in the UK, it's the Bank of England. In Europe, it's the European Central Bank, the Bank of Japan, the People's Bank of China, the Reserve Bank of India, the US Federal Reserve Bank. So in every currency, we could say every country, but it's really every currency. In Europe, you've got lots of countries, but they only got one currency in the Eurozone. In every currency, you've got the central bank who controls the supply of money. And they don't want to lose control of that. And cryptocurrency represents a creation of new currency that's outside the central bank's control. Now, people should remember that central banks and central governments won't put up with that forever. I mean, for one thing, central governments, like the Australian government, the US government, the European government, then when they create new money, when you take a sheet of plastic and print it up into 50s or 100s, print it up into 50s and then chop it up, and now you've got all those pineapples, all those $50 notes, who gets the value of turning a sheet of plastic into $50 notes? That, by the way, that's called seigniorage, that value of creating new money. When new money is created out of thin air, someone must get the value. Well, you'll be unsurprised to know it's the federal government gets the value. Now, when someone creates a cryptocurrency out of thin air, who gets the value? Well, the creators of the cryptocurrency. Now, do you think that federal governments are going to allow the creators of cryptocurrency to take away their monopoly to create new money and to control the amount of money in circulation? So, cynical old economists like me look at that and think, they're just not going to put up with that forever. So we need to, I say that because it's related to what we were previously talking about with the supply of money and inflation, and people investing in cryptocurrencies need to bear that in mind, that it won't necessarily be put up with forever. Okay, so other things. So investing in shares. Now look, inflation wouldn't really affect investing in shares so long as it flows through the system. So if you're a company and your revenues go up by 10% because of inflation, so let's say we had 5.1% inflation last year. Now let's say you're Coles and the price of everything you sell goes up by 5.1% on average. So your revenues go up by 5.1% and your costs go up by 5.1% because people are selling stuff to you at 5.1% more. You're selling it on to consumers through your stores at 5.1% more. Your workers are getting paid 5.1% more. Your profits are going up by 5.1%. It wouldn't really make very much difference to you as an investor in a company. Getting dividends every year, the price of the shares will go up by 5.1%. The dividends will go up by 5.1%. But that depends on the ability to pass costs on. What if what you buy from your suppliers goes up by 5.1%? But then your customers refuse to accept a 5.1% increase. And they go somewhere else. They go to Audi or they do something else. They go to the Sunday markets, or they buy from Amazon online. If you can't pass your costs on in an inflationary environment, then your profits are just going to go down. So this is a really big issue at the moment, and it's an evolving issue. We don't know whether companies will be able to pass on these higher costs. And so it's a level of uncertainty that we can't really get around. And you can see that in the volatility of the market. The market's up, it's down, because one day people are quite bullish and they're thinking, yes, those costs will get passed on. Yes, the economy will continue to grow and there'll be same growth in profits. So there'll be real growth in profits. There'll be the inflation growth in profits because the costs can be passed on. Next day, everyone's bearish. Oh no, we're heading into a recession and we won't be able to pass the costs on. So it's all going to go down. So it's very volatile because of that switching backwards and forwards between being bullish and being bearish about it. I can give you my view here. So I should say that we are about to step away from the world of economics and science and into the murky world of Sam's opinion. And so we need to be clear on that. So here in Sam's opinion, I'm concerned about it. So I wouldn't be inclined to increase investments in shares, especially in the US. So I think that the US shares are more vulnerable to increases in inflation than Australian shares. They're starting from a much higher point, from a much more pumped up value or overvaluation of US shares. And the Australian market's not. And the US market's more vulnerable to increases in inflation. There's a lot more quantitative easing that has to be unwound in the US than has to be unwound in Australia. Remember, QE only started in Australia in COVID-19, and it started many years before that in the US. So for a variety of reasons, I'm much more bullish about Australian shares than about US shares. And it does depend upon how inflation plays out. Now, let me just say one last thing, and I'll just say it very quickly, and it's this, that people think that interest rate increases will tank the property market in Australia. That if mortgage rates, the RBA increases interest rates by 2 or 3% to fight inflation, mortgage rates will go up by 2 or 3%. That's correct. And then house prices will go down by a huge amount. By, some people are saying 15 or 20%. I think that's very unlikely. For a good reason. And it's this reason. It's that when the demand for shares, for instance, let's just jump back to the stock market. When the demand for shares goes down because people are worried about inflation or growth or something else, the supply stays the same. There's still the same number of shares available for sale. So to get back to an equilibrium where demand and supply for the shares equal each other, price has to go down a lot. Prices have to go down until some people who previously wanted to sell now want to buy. All of the getting back to equilibrium from lower demand it occurs in the price changes. Now, when you go to the property market, to the residential property market, that's not true. When prices start to fall because of lower demand, interest rate goes up, people aren't buying as many houses, demand's down, prices start to fall, supply goes down. People step back from the market. You know what? I was going to sell my house in Randwick and move to Fremantle in Western Australia, but now I'm not because my house price has gone down. I'm going to wait till it goes up. I was going to move from Carlton in Melbourne to Noosa in Queensland, but now I'm not because my house price has gone down. When the house prices go down, people pull back from the market. Supply goes down. What meets a fall in demand in the housing market is a fall in supply. Now, I'm not making this up. This has happened over and over again in Australia and around the world. This is just a very well-known thing that reductions in demand, which will come if interest rates go up a lot, won't be as much as people think by a fall in price because it'll be met by a fall in supply. People will withdraw from the market. So I don't think people should worry about increases in prices tanking the real estate market as much as they have been worrying about.
It's interesting, as someone who's looking at property right now for their first home, I want property prices to fall, but I guess on the other side of that, there's a lot of people that own property that do not want the price of their asset to fall. So it's quite interesting looking at both sides of it.
Yeah, and it's hard to time it, isn't it? Look, I think the main thing, Kate, is that you shouldn't be worried. You shouldn't have a fear of missing out at the moment. You shouldn't be worried that prices are going to zoom up. So you should take your time. That's what I would do if I was you. And the other thing that I would do is I spend a lot of, I know you didn't ask me for your advice on this, but I'll just give you some unsolicited advice.
Why not?
The other thing you should do is, if you don't know where the bottom of the market is, you should put in low ball offers. This is sort of a general idea. So inflation's up, so we know interest rates are going to go up because the Reserve Bank's told us. We know that that's going to make demand for properties very soft, and we know that that will cause prices to fall. Now, I was saying a moment ago, people are exaggerating how much prices are going to fall because they don't understand the supply and demand dynamics. They haven't had a good look at the data over long periods of time. But look, prices are going to fall. And if you don't know where the bottom is, then it's a good idea if you make an offer, to really lowball it, to come in with lowball offers, so you don't have buyer's regret, where you were thinking of buying something. I'm just going to choose some numbers here. I've got no idea what you're thinking of buying, but let's say you were thinking of paying $700K for an apartment, and you're not sure. What you don't want to happen is to buy it for $700K and then the price to, sometime soon, similar apartments to be selling for $620K or $600K. And a way to avoid that is, if the property is selling for $700K, then come in with an offer that's only 80 to 85% of that.
Yeah.
So come in with an offer of under $600K. Now, if you were worried that the market would go up while you were doing that, you would come in with a full offer because you're worried that someone else will buy it and you won't get it. You might even come in, if it was $700K, like a year ago, if it was $700K, you might even come in with $710K because of the fear of missing out. Well, that's all gone now. And the opposite of the fear of missing out is the fear of paying too much. And the way to avoid the fear of paying too much is to take your time, and when you make offers, lowball it. And when you, just say one last thing, I know I'm going on here a bit, but when you speak to the realtors, okay, if the offer is too low, the realtor will say to you, I'm not taking that offer to the vendor. So it's 700K, if you come in with 550K, the realtor is likely to say, oh, look, Kate, I'm not taking that to the vendor. There's no way she will accept it. And that's that, okay? But that tells you something about their bottom line on the other side, doesn't it? And so if you up it a little bit, and then they say, okay, well, now I will take the offer to the vendor. Now you sort of crossed a threshold here as to what's even possibly acceptable to the seller of it. So you need to test that threshold. And one way to test it is whether the real estate agent will take your offer to the vendor. I know a lot of properties are sold by auction as well, and you need to do similar things when you go to auctions. A year ago, you would go into it thinking, I may have to pay 10 or 15% more than the reservation price. Now you should be going into it thinking, this thing might not sell, and then I'm going to negotiate afterwards. I'm going to make a lowball offer and it won't sell, and then I'll go into a negotiation with the vendor. Anyway, I just think that in this market, this soft market where you don't know where the bottom is, take your time and don't pay too much.
I think that's great advice, Sam. I know I'm conscious of time. I might ask one quick follow-up question from a listener. And the listener question was, what should a 40 plus age group be doing with their finances apart from saving and in regularly investing? Is there anything outside of that?
Well, so saving and regularly investing is obviously a big part of your finances. So you've got a long way to go. So let me sort of point to a couple of things here that you haven't mentioned in that, and that you want to get right. So you want to take the right amount of risk. So save plenty of money, and then take the right amount of risk for the long journey that you're on. Let's say you're 45, okay? You're going to live to be 95. I'm granting you a long life here. So,
I'm sure they'll appreciate that.
I'm not sure that's within my power, but you're going to live another 50 years here. It's a long journey, and you're not even halfway through it. So don't pull back on the risk just because you're 45. Think about where you should be on the risk spectrum. Should I be a little bit to the right, taking quite a bit of risk? Should I be a bit to the left, not taking so much risk? And what really goes into that is your age. 45 is pretty modest in age. So let's say you're 20 years from retirement when you're 45. Then you've got a long way to go. That means if something goes wrong, there's plenty of time to make up for the thing that went wrong. So take a bit more risk on the basis that you have a long way to go in the one notch to the right, because you've got 20 years to go in employment. And then think about the stability of your income. So do you own a risky small business, which is high risk and high return? It's great to own your own business, but it does mean that you've got enough risk in making money, and you want to take a bit less risk in investing your money. It's more about wealth preservation if you've got a lot of risk in the making of money. Or let's say that you work for the federal government and you have let's say that you're a teacher in a public school. Then you have very stable employment. And that means that you can take more risk in the investing of money. So the small business owner is going to be more to the left on the risk spectrum, and the teacher in the public school is going to be more to the right. So your age, the stability of your employment, your obligations in life, and I'm thinking here of any kind of special obligations, like if you had children who had special needs or something like that. And then your level of risk aversion. I won't go on and on here, but what about your personality? Are you someone who can take a fair bit of risk, or are you going to sweat it? And is it going to keep you up at night? That's going to move you to the right or the left. So get yourself to the right position on the risk spectrum. And the most common thing is that people don't take enough risk. And the most common way that people don't take enough risk is that they just pay down their mortgage. So they buy a house, and their saving is compulsory super plus the paying down of their mortgage. And then they buy a nicer house. They move to a nicer suburb, and now they've got another big mortgage. And they spend most of their investment journey, like they get to the point where retirement is coming up over the horizon. And suddenly they realize, I've spent my whole investment journey over the last 25 years paying down my mortgage. I never did anything else. I didn't sort of put my money into something that was a bit higher risk, higher return. I paid down my mortgage, and it just moved me further and further to the left on the risk spectrum, not matching where my age and my personality and my obligations and my employment stability actually put me on the risk spectrum. So, look, I would strongly recommend that. Get your position, figure out where you are on the risk spectrum, make sure that your investments match that. And a very common thing is that people aren't taking enough risk. And the most common cause of that is just spending your whole investment journey paying down your mortgage.
That's a really good way to think about it, Sam. And I don't think we often think about how the source of our income plays into our risk tolerance. I mean, I haven't thought of it that way. It's usually just, how do I feel about, what's the typical question? Like, how do you feel if your money went down 30%? That's often the question to gauge risk, but actually looking at more than that in your life holistically in terms of where do you sit on that risk spectrum and not just falling into the default category.
Yeah, and so look, the difference between making money and investing money, it's really important, and in a couple of ways, right? So in the making, just think about diversification. So in your investments, you want to be very diversified. So you want to be diversified across asset classes, meaning across Aussie shares, global shares, fixed income, which means bonds, across residential real estate, commercial real estate, and then private assets like private equity, et cetera. So you want to be diversified across asset classes and then within asset classes. So in Aussie shares, you don't want to just own BHP. You want to own BHP and CSL and JB Hi-Fi and 15 or 20 different shares to be diversified within the asset class and across asset classes. That's in investing your money. Now think about making money. In your career, the exact opposite is true. You need to specialize. We were talking about this earlier, thinking about, about your sort of career journey, improving your skills. And that's about specialization. You have to specialize. And if you own a small business, then you have to work out what your customers want and really go for it with that. If you try to be everything to everyone, it'll be hopeless. And it's the same with your career. If you try to learn everything or specialize in everything, you won't be of any use to anyone. You've got to specialize in the making of money, and you've got to diversify in the investing of money. And they're the opposite of each other. In those, risk is the opposite of those two things. And there's other ways that things are the opposite in the investing of money versus the making of money, but maybe we'll talk about that next time I come back on the show.
Yeah, fantastic, Sam. We've covered so much today. Honestly, I could just sit here and just listen to you talk for hours. And I am a bit envious of students who do get to hear you talk and present. I know that you have your own website, you have your own videos, a course. Maybe we can just give a bit of a shout out to that, Sam. If people want to learn more about you, where can they go to follow up with you and to learn more from you?
Well, so I do have an investors course, which is called Finance Education for Investors. And so if you just Google Finance Education for Investors, Sam Wiley, and that's WYLIE. If you Google that, then it'll come up, and you'll come to our website. You'll see what the course is like. You'll see that I have a newsletter that you can subscribe to, a free newsletter that you can subscribe to. So that's the thing. Go to just Google Finance Education for Investors, Sam Wiley, WYLIE. Yeah, thanks for that.
We'll put links in the show notes as well. We're so thrilled that you were able to join us again, Sam. So thanks once again on behalf of Kate and I for taking the time out, and on behalf of all of our listeners for educating us on the economy, interest rates, inflation, how we can protect ourselves and how we can invest sensibly, and particularly that risk commentary on the end there. I think Kate and I are going to take that and run with it. Maybe a lesson for our small business, Kate. So thanks once again, Sam. Really appreciate it.
Yeah, thanks for inviting me back. Really enjoyed it. Thanks, Kate. Thanks, Alan.